Adani Group stocks and Zomato will be top of mind. But first up, let's get our first guest on the show. Steve Brice, who's the Chief Investment Officer at Standard Chartered Wealth Management, joins in. In a bit, we'll have Brandt, the Director of Research at EPFR Global as well. Gentlemen, morning to both of you. Steve, let me begin with you. There were dovish undertones that came through from the Fed, and that has raised investors' hopes that perhaps the worst of the macro downturn is behind us and the worst of the rate tightening cycle as well could be over. Is that your best guess? And if yes, how do you think equities could react to it globally through the course of the next many months?
Yeah, so clearly we think that the majority of the Fed tightening is out of the way. That's pretty clear. The question is, how much more do they squeeze into this before we see actually them go on hold for an extended period? So our central scenario is that we'll see one rate hike. We are skewed slightly to 2 versus 0. So, if we were to see 0 rate hikes, I would peaked already, would be very surprised. But 1 or 2 seems to be what is likely here. But that doesn't, from our perspective, that doesn't mean we're in for a soft landing. I think that the way that we look at the world is saying the yield curve has been inverted alongside a lot of other indicators that suggest the economy is weakening quite considerably, obviously outside the labour market. So from our perspective, the yield curve inversion since mid to late last year suggests the Fed is already tightening too much. It's tightened another 150 basis points since October. And therefore, we are heading into recession. It's just a matter of when does that happen. Our best guess is that happens around mid-year this year, so not too far away. Of course, the recent data may suggest that could be pushed back a little bit, but overall, we think that the macro environment still, at least in the developed world, is still looking very fragile.
Steve, but contradicting the fact what the U.S. yield curve seems to be suggesting, that is a recession is due, is the jobs data, right, from the United States. Last week, it was exceptionally strong. So how do you marry the two data? Because on one hand, the inverted yield curve seems to be suggesting that a recession is coming in the U.S., but on the other hand, the jobs data is still very strong.
Yeah, so if you look obviously at the NFP number, as you say, it's extremely strong. But if you look at the underlying data, even from the labour market, now labour market we should acknowledge is a lagging indicator, right? But if you look at the data outside that, you look at the quarterly data, that's been a significant divergence from Q3 last year, actually, which suggests that the labour market is not as strong as NFP itself suggests. If you look at small businesses, which have been obviously the ones that have been hiring the most, you see large cap job cuts on a daily basis. So small enterprises are the key to this squaring the circle, and their intention to hire index has started to weaken significantly as well. So from our perspective, the more forward-looking indicators suggest that even the labour market is likely to slow down quite quickly as we go through this year. Obviously, the question then comes, look, inflation is still going to be above the Fed's target for the rest of this year. So the question is, okay, when do they start focusing on growth and ignoring inflation? We're still some way away from that point. We do expect rate cuts in the end, towards the end of this year, but that's not the focus for now.
Okay, all right, Steve, just hold on to that thought. Let's welcome Brandt as well into this conversation. Hi, good morning. Thanks so much for joining in. Well, how are you reading the flows picture? I mean, the sense that we get an updated number that comes every evening. And that was suggesting that FIs, maybe they're selling a little bit less in the Indian markets. What's your sense on the flows? And, in the last 2 weeks or so, we have some negative news coming in on a particular group, that's the Adani Group. Have you seen any kind of flows, either the FI flow is getting a little bit more aggressive? Some color on that. Go ahead.
Right. Certainly what we're seeing is investors not wanting to miss the upturn, but an early conviction that the Fed was barking more than biting has begun to crumble. And certainly this week, the flows have been marked by a great deal of sort of second-guessing earlier convictions, which certainly boosted flows through the first 5 weeks of this year.
All right. So, Steve, before we end the discussion, how do you think viewers who are watching you right now, right, an Indian viewer, how should they approach the markets now? Is this a good time to be accumulating, assuming that perhaps the worst of the rate tightening cycle is behind? Do you think the worst of the macro problems in India as well are behind us? And what about the India versus China argument? Because most believe that money is going to move out of India into China. Then what happens with the investment rationale here?
Okay, so there's quite a lot to get into there. So let's just talk about the developed markets, so US equities picture to start with. So we still feel, against the backdrop of that recession outlook that we have, that there's likely to be another leg lower in equities. Obviously, that's been a difficult view to hold on to so far this year, because we've seen equities just do nothing but go up. But we do think we're still going to see another leg lower. So we would be waiting on the sidelines for that before adding to equity positions there. On the China versus India, look, I mean, obviously we've seen net outflows from India. You alluded to it in an earlier segment. Last year, we saw net outflows from the Indian market. What's interesting to me is that those flows seem to be ebbing somewhat, despite some negative news flow, right? So from that perspective, it suggests that the need for people to sell Indian equities from an offshore perspective is much reduced. And therefore, we do see stronger returns for the Indian market, but we see even stronger returns from China. Now, we're seeing some consolidation there, obviously, in recent times because of the very sharp rally. So we alluded to this in our weekly report over the past couple of weeks, saying that some sort of consolidation and reversal was likely in China, but the macro picture there still very positive. Inflation data today not suggesting that the authorities are going to have to tighten down on policy anytime soon. So from our perspective, China over India, but India still experiencing a pretty good 2023.
Okay, gentlemen, we leave it at that. Thanks a lot for joining in, and have a good day, have a good weekend as well. Let's take a quick break on that note. So many stocks to talk about on the other side of the break. So don't go anywhere. We'll be back in just a bit.